It's time for Ask Mike Mondays. Mike answers one listener's question every week. Here's Michael Becker and Paul Peebles.
Welcome to Ask Mike Mondays. I'm your host, Paul Peebles, National Underwriter for Old Capital. And joining me today, it's after a little bit of a hiatus, but we keep on taking more hiatuses. The man himself, Mr. Michael Becker. Michael, how are you?
Hey, Paul, doing good. It's good to be back at it. We need to get a few more recordings on a regular basis. Been busy summer and I guess we're still in summer, but been a busy summer for sure.
It certainly has been a busy summer. And one of the things I want to talk about today, really a couple things. One, let's talk a little bit about the Old Capital Conference. Two, let's talk a little bit about the change of what has happened with the Feds just recently of a 0.5% decrease. Then three, just talk about the state of the market, about a little bit about what's going on. So I'll start off first, and we'll talk about the Old Capital Conference coming up here on October 9th and 10th. There are just a few tickets that are remaining to this spectacular event. I think it's the premier event in North Texas, in Texas. When it comes to multifamily, it's really all the players, whether it is brokers, whether it is bankers, whether it is other investors, just to kind of figure out what the state of the market is in apartments. You know, we've gone through a tremendous amount of headwinds in the last, say, 2 or 3 years. And a lot of people are thinking about jumping back into the market itself. And we would advise you not to do it until at least you've talked to some people about what's going on and trying to get everyone's perspective. So don't spend your hard-earned money until you kind of figure out a little bit about what's going on. So RSVP, go to the oldcapitalconference.com, oldcapitalconference.com, and then kind of join us in Dallas. You have to get up, leave wherever you are, go to the George Bush Museum. That's where it's at, or George Bush Library in Dallas at SMU campus, and join us for this really a 1.5-day event, and I think you would like it. Mike, any feedback concerning the conference? You've attended for the last 7, 8, 9 years or so. What do you think?
All of them, right? Yeah. It's a great event. Like unlike some other events that I go to, this one is, people that are actually doing deals in the room. You got a lot of brokers there from all the various shops in Dallas-Fort Worth and Texas in general. So there's quite a few actual brokers selling the properties that you guys finance and our listeners, invest in and buy. So it's a great networking thing. Lots of limited partners, lots of general partners there as well. So I think it's a deal makers kind of conference. You get a lot of people that out there actually doing transactions in the marketplace. So I always tend to have a good time and network, and it's definitely a good event from that perspective.
Yeah, oldcapitalconference.com, oldcapitalconference.com. Come join us. You'd like what you're going to see. Hopefully you understand what's going on. So if not, engage us, and we'll be more than happy to bring it down to the bottom shelf and just kind of explain a little bit about what it takes to invest in apartments. It's a new day. Is it happy days are here again, Michael? Happy days are here again. Is that the song we should be singing and dancing to for this 0.5% rate cut? What's your perspective?
Yeah, I mean, I think it certainly net is positive for guys like us. Certainly been, a lot of that's kind of priced in. I know it was kind of a debate between 25 and 50, and they went a little larger and did the 50. So that's, and set expectations for future cuts. 2 more cuts likely this year, and at least I think it was a point to 1.5 are priced in for next year, 2025 and cuts. So kind of getting around that 3.5 is kind of what the Fed is saying. They're going to kind of land somewhere in 3.25, 3.5 on the Fed funds, kind of the new neutral rate. Our buddy JP at Pensford always says that the market tends to underestimate the actual path of cuts. So this kind of history says they'll probably cut more than what is priced in and kind of expected. So we'll see how it plays out in reality. I mean, every time's a little different. So seemingly the economy's still generally holding up, because years ago they dumped $5 trillion in the economy. So that's still kind of working its way through and supporting a lot of stuff. But for us, it's just a great day to see that. It's been, I think it was 420 days from the last hike to the first cut. So, 14 months or 15 months or so. And then, it's been a long time since we last got a cut. That was kind of in, I think, May or something like that of 2020, in the middle of COVID, is the last time they actually cut rates. So been a slog of 30 months, really, Paul, since they kind of started the hiking cycle in March of 22. So it's been a minute since I remember what a good market feels like. So I can't wait for a good market to kind of rebound. But as we've been talking about for, well over a year now, it just seems like there's there's some, light in the tunnel. A lot of our issues and multifamily have been, kind of centered around two things. One, if you had a variable rate mortgage and you had to repurchase a rate cap, whether you're capped or you're uncapped, your debt service went up, and then your cap kicked in. The escrows on the replacement rate cap certainly were pretty dramatically higher, 100x in some cases or greater. So it was an extremely steep move in a very short period of time. So it's been sucking up a lot of money. And, we really haven't seen as much distress as you would have thought in the marketplace. You are seeing some headlines of some of the operators that were over levered and had floating rate debt and inferior type products, properties and locations. They're seeing some foreclosures, but it's not by and large. I don't think that story's over. I think there'll still be some of those kind of coming through. The 50 bip cut isn't a magic elixir that's going to solve all the world's problems, but it certainly is helpful directionally going there. A lot of that was already priced in the 5, 7, 10-year treasury rates. So actually after the cut, the longer end of the curve actually has gone up. The 10-year yield has actually gone up a little bit as well, which I don't think is overly shocking to me. But, I think directionally good as Paul. I think we're seeing the supply was the other big headwind that we've seen, especially if like a newer property or depending on what submarket you're in or what market, and then the submarkets with supply was largely across the Sun Belt. Quite a bit of it in Texas and the markets that we play in. So, but that's a burning match. So there's been starts are way down as we've talked about many times, and it's just a matter of completing what's already in the pipeline. And every day we're one day closer to that kind of being done. So, I've kind of been pegging plus minus Q2 of 2025 is when we see a dramatic drop in new deliveries. I think Dallas will be a little sooner, and Austin might take a little bit longer for that to kind of play out just with the amount of supply they have. But I think it's coming, and I think the institutions are back in a big way. That's kind of what we're seeing as well. The biggest institutions are all have bought in Dallas or actively trying to buy in Dallas. So I think we've seen quite a bit of that. And then, I think the players kind of the sub-institutional kind of JV private equity partners are starting to dip their toe in. I'm still seeing quite a few of those guys trying to find reasons to say no versus finding reasons to say yes. But I think, that's a matter of time. I think the election is probably the next big thing to get behind us. And no matter which way it goes, just having that kind of behind us, I think is going to be good. And then you flip the calendar to January 2025, and I think it's going to be a rush to try to get in these deals before values gap up. So I think if you could, anything you buy, right now, I think you're going to be looking smart in a couple of years. So I think it has been go time for a little while. And I think that's still here, and we're closer to the all clear, Paul. So that's kind of my rambling thoughts of the market right now.
Well, I love those rambling thoughts. Talk a little bit about, nobody has their ear to the ground more than you do with some of the brokers. You've spoken to a number of brokers out there, whether it's the institutional brokers, those are the guys that sell the big Class A plus properties in some of the suburban or urban areas, or you've talked with some of the brokers that sell the 1960s and 1970s properties out there, the ones that have flat roofs or chiller boiler systems, or they were a Class A building about 50 years ago, but that's what happens to age and time. That's what a Class A building becomes eventually a Class C property. What are some of the brokers saying out there? What are your contacts saying?
It seems very disparate between the two subsets. So if you're selling 60s and 70s, maybe even early 80s product, predominantly those guys are much slower. So there's some activity going, no doubt, but there's still a little bit of a bid-ask spread. And I think a lot of the owners don't want to take their loss. A lot of those guys that, if you kind of bought, you just kind of pre-COVID, post-COVID, are really still been the split. So you bought post-COVID a deal in 21, 22, early 22, you're probably, upside down on your deal, especially if it's an older workforce housing deal. So, if you don't have to sell, you're not forced to sell, you don't want to sell, but some people are being kind of forced to sell. Either have to buy a replacement cap, or they have a maturity coming up with a big cash in refinance and can't raise the money, or whatever it would take to kind of extend the loan out. So those are the ones that are actually kind of selling right now by and large. But there's quite a bit of still lower than historical norms from a transaction standpoint. I think that'll hopefully pick up first part of next year as we kind of get into 2025. I would expect that volume to start picking up on the downstream. What you're seeing on like the top of the grade, I mean, there's been a big push, lots of deals hit the market here recently from merchant developers and kind of larger developers across the country. So you've seen a lot of listings that have been out, especially in Dallas Fort Worth. We've seen just a big push. The top shop in town from volume and that space has been IPA, and I think they probably have 15, 16 deals out, or so, maybe more right now. So those guys are busier than can be, and a lot of the competitors have several deals out as well from kind of that brand new construction or recently completed construction. So seeing a lot of activity on the top of the grade from a listing standpoint, and not as much on the bottom of the grade right now, Paul.
So maybe some of the brokers and some of the mortgage bankers have had to sell their second house. Business has been challenging for the last, say, 2 years. Maybe some of the gurus, the ones that have been educating you how to get into the business, have had to sell their airplanes. And then maybe some of the operators of some of these properties that chose the high cost debt with the highest leverage they could, maybe they'll eventually get out of the business and go out and do something else at some period of time. Tell me more about more of the opportunities that are coming on that you're seeing out there. And what's the ray of hope? Because we've just seen this 0.5% cut in interest rates, but we also talked about that we thought in October, November of last year, we thought the bottom had been hit in the class A minus stuff. What's the opportunity out there for just like the average investor?
Yeah, I mean, I think we've seen the two primary markets we're focused on are Dallas and Austin. So Austin's still pretty difficult to raise capital in. It's not as many transaction volumes, and the pricing's off considerably. But it's a hell of a good time to buy for basis. I think for sure, especially when you're kind of buying newer vintage. And then Dallas Fort Worth. I mean, I think you've seen the Class A bottom. I think I call the bottom was probably October of 2023 when the 10-year Treasury hit 5%. So I think since then we've been kind of recovering off of that. So you've seen these cap rates of market wide probably trade south of 4 more than they do south of 5, more than they do north of 5. So they got like a 4 handle on them with this brand new stuff. I mean, a lot of these the market cap rates, probably 490, plus minus is probably a market cap rate for a newish construction deal in Dallas Fort Worth. Austin, you're kind of trading on a per pound. It's not necessarily a cap rate metric, but it's below replacement cost. I think Dallas, where you no longer by and large can buy brand new construction below current replacement cost, as you could have last year. It's just that's buying. I'm not saying there's not a deal here or a deal there, but by and large, values have moved up. And I think this fourth quarter, there's going to be all these deals that are actively on the market right now. When those kind of gets those data points set and they close, I think it's going to kind of jump up. I think the price per unit. So I think it's kind of moving up. I think on the workforce housing, that's held up pretty well overall. I mean, just hasn't been as many trades. But, we bought a couple of deals in the summer that were, a considerable loss for the guy who sold it to us. So they were a little older vintage deals up in Denton. We bought with the family office, and those are out there, but there's not much in volume. So yeah, I definitely feel like it's recovering. As we speak right now, we actually have a deal in escrow. We'll be bringing it out to raise money on in October, and it's I won't name the name of the deal right now, but it's mid-90s deal in Dallas. Well, very, very well located near my house, actually, over on the east side of town. And, it's got, had some of the units have been upgraded by the current owner. And there's some opportunity to do some more, but it's, 90s deal. So 9-foot ceilings and the modern construction quality in a very well located deal. And, we got it a little while ago when the rates were kind of a little higher, and then rates have fallen. So we actually have around 50 basis points of positive leverage with our debt having a 4 handle on it, and our cap rate kind of be in the mid 5s. So we feel like it's a pretty good moment, and we feel like it's starting to move upwards in pricing per units and downward in cap rate, generally speaking. So I think it's gonna weather well with the test of time. So that's the next thing we have coming up, and that'll be in October for us, and that'll be our first kind of big syndication we've done in a while. So I'm excited to get out there and put it in and get a 2024 closing on the books. I think there'll be a little bit of push for some 2024 closings as well, because you'll have some, this is last year, 60% bonus depreciation too, Paul. So I think that's a motivating factor for some people that need some depreciation. And there's not a lot of deal flow out there. So next year's going to step down to 40%, and then it's going to be fully phased out by 27. So I'm not sure if this is going to get extended or not, but that's kind of the way that it's currently sunsetting. But yeah, we're excited about this new opportunity.
So it's the fall. Got Texas football, which everybody likes to see in Texas. I can't tell you I'm the biggest fan of football, but football has two teams on different sides of the field. And I'm trying to think here. One side, when we use the analogy of football with apartments, one side was the value add team jumping up and down, spiking the ball. The other side was the stabilized cash flow team. And for the last, 10 years, it's been a tackle left, tackle right, and that the value add's been winning up until like last 2 years. So the value add has won the national championship a lot of times. Now, what's your prediction? Is it the stabilized cash flow team going to win this year in multifamily?
I think, yeah, if you look into the rearview mirror, I think so. If you're looking going forward, I don't know as much. I think generally speaking, my view of the world, I think is largely the relative value at the moment in time is new in Austin and a little bit older in Dallas. So, that could be like a 90s deal there's some value add, or that could be a 70s deal, 80s deal too. You just haven't seen as many of those trade. But I think, yeah, a little bit older in Dallas, a little bit newer in Austin is kind of my general view of the relative value. So I think that's what will outperform as we kind of go forward in your analogy. But if we look at backwards, I think, the value add guys have had some challenges in the 60s and 70s and 80s kind of space. It's been a tough road to hoe for a minute. But, I think there's definitely some green shoots out there. Like I said, supply is burning off. We got a rate cut. The long end of the curve is already down. Loan spreads are pretty tight. The agencies are loaning money. You're starting to see these other banks that are kind of been doing problem loan workout and running their clients off. Now they've run off a bunch of loans, and they're probably going to need to go make some new loans because they can't stay in business unless they loan money out. And I think they're going to realize that. Life cos are out there. They're abundant. So there's some debt funds if you want it. There's an abundant amount of capital. You're close to the capital markets than me. What are you seeing? To my view of the world, there's a ton of liquidity, and it seems like pricing of that debt is getting cheaper and cheaper by and large relative to 12 or 18 months ago from like a loan spread and upfront cost standpoint.
With interest rates coming down for the last couple months and really kind of a watershed having this interest rate come down by 0.5%, I think a lot of people are thinking about refinancing some of the bridge loans to go to agency, and then some of the operators are going back to doing just Fannie Mae loans across the board, Fannie Mae and Freddie Mac loans. The issue is with the agencies to a certain extent. They're not closing loans like a bridge lender would be within 30 to 60 days. They could take 60 to 90 days now. They're just inundated with just so many folks that are trying to get out of their bridge loans and bring it over to agencies. So the agencies are just going to tap the mat at some period of time, saying that there's just so much business. They just don't have the staff to cover it. They're very active these days. Another thing that I'm seeing that we'll probably talk about at the conference is the difficulties trying to get some of these loans through some of the agencies and what they're requiring now to get done. So we've had a number of transactions that they're really concerned, and up front, Freddie Mac, is the condition of the asset. A lot of these assets that were done with bridge loans, a lot of them, the lenders didn't really care about the condition of the asset. They were more concerned about the condition of the debt yield. How, if we were to do improvements to the property, how big of an improvement would it have to your NOI, to your cash flow of the deal? And sometimes if the NOI wasn't going to be there that you had originally said was going to get there, they would hold back construction dollars or rehab dollars to get it done. So some of these properties haven't been touched. Dollars haven't been spent in a number of months or even years. And so when a new lender comes in like Fannie Mae or Freddie Mac and takes a look at some of these properties that haven't been touched in 2-3 years, they're concerned about the quality and condition of the property, the health and safety of the asset. So I think that's what we're seeing today, is that they're taking a first, second look three times to kind of figure out what the condition is of the asset. So I just want to make sure everybody's aware of it, that it's not you that owns that property. It's the U.S. taxpayers that own that property if you deal with Fannie Mae and Freddie Mac. And so the government's going to stand behind the taxpayers and making sure that their assets are clean, healthy, and safe. Anything more on that, Mike?
Yeah, we don't have a lot of older stuff anymore, but I've kind of heard anecdotally the same thing. Is especially if you have a property up here in North Texas, Fannie Mae's got a big regional office. So they'll just go take you out of the office, go drive a bunch of deals before they're quoting them, and seeing if they're in terrible shape, and especially if it's a refinance in particular, because the current owner hadn't been taking care of their property. So I've heard that several times as well. But the other thing I'm thinking about too is just the loan spreads are still really tight from a historical basis. So you're with a buy down, you're able to get near a one, kind of near a 1% spread if you're a more preferred borrower, maybe a little bit higher than that over the index if you're not a preferred borrower after you buy it down. So it's been pretty tight. So I think we're kind of seeing a lot of these deals are kind of getting priced with the four handle on them, which is great. I mean, these older deals are trading probably close to a six cap, maybe high five into sixes, depending on the vintage and location of the older deals. And like I said, the brand new Class A deals are kind of more neutral leverage. Those are kind of, around a high 4 to 5 cap range for these newer deals by and large in the marketplace. So that's, either neutral to positive leverage on your debt. And, we went many, many years where that wasn't the case. So having that to be the case is, encouraging these deals can, produce some yield and pay a little better current dividends.
Absolutely. Maybe it's time to jump back in the water. So go to the Old Capital Conference, sign up to learn a little bit more, to see where the market's at in more depth and build those relationships with key players in the marketplace in the Dallas-Fort Worth, North Dallas, North Texas area. And then, Mike, tell us a little bit more about what you do over at SPI and what SPI does.
Yeah, the main focus right now is just trying to get high quality deals put together and put them out and, syndicate the equity. So that's kind of what we're doing. Like I mentioned, we have a deal coming up in Dallas, kind of an A-minus 90s deal, 9-foot ceilings, and in a very, very good location, very supply constrained submarket. So very excited about that. That's our next opportunity. So if you guys want to, if you're not in our database, want to get in the database and see the opportunity when it comes available in mid-October, just go to our website, which is spiadvisory.com. That's SPI like spy advisory.com. There's a vest tab. You click on that, you can fill out the form to get into the database. So we do quarterly newsletters and put opportunities. So hopefully this is the first of several future deals that we can put out syndicate. It's been a little slower on the syndication front than we would like. It's been probably over a year since we did a wide scale syndication. So we've done a couple smaller things here or there. So I think it's a great entry point to the market. I think it's been good for the last 2 years from a buyer's perspective. It seems like I said the fundamentals are starting to kind of firm up in the marketplace. Occupancy's ticking up a little bit. Rental rates are firmed up across the board, much more than they were just kind of going in the first part of the summer, especially up in the Dallas-Fort Worth area. So a little tougher down in Austin, but in Dallas-Fort Worth, we're starting to see rents firm up and positive trade outs. So we're seeing debt rates have come in, and I think this is kind of likely to be higher pricing from here on as more and more entrants kind of into the market. I mean, as rents start growing, and as I think we're like we've been talking about for a while. I've been talking about for a while. Today's oversupply setting up tomorrow's undersupply. So there's a backside of this curve, and that's where I think the institutions are front running, because they know that come 6 to 9 months, the supply story is completely different than what it has been the last 6 to 9 months, and that's just around the corner. So if you can get in today at attractive pricing, I think we're going to start seeing the rents really gap up as supply stops and the demand and the population keeps growing here in North Texas and Texas in general, and Sunbelt in general, but North Texas, Dallas-Fort Worth to be specific. We have a tremendous amount of in-migration every day in, day out, still moving into our marketplace. So our population is growing and growing, and we have going from some supply to no supply on new deliveries is really just going to should make the rental rates grow at a higher than historical norm average. So couple that with lower interest rates all at the same time and abundance of capital, I think we're setting ourselves up for the next so onset of the next bull run is kind of what it feels like to me, and that's my crystal ball. reserve the right to be wrong, but that's what it certainly feels like. Is we're just on the very onset of it. So it might be like the last big cycle. This might be like 2011. Kind of be like buying a deal in 2011, 2012 is probably a similar time. I can't imagine this run goes on for 10 years like the last one did, but
No.
Have a 4 to 5 year run ahead of us. This would be a good entry point for sure.
I agree. Mike, some great information. If you want to get a hold of Mike or start getting his newsletter, go on to spiadvisory.com, SPI Advisory. And I'm Paul Peebles. We'll see you at the Old Capital Conference on October 9th and 10th. Thank you.